If you think you're making money in the stock market right now, there's a real chance you're actually falling behind. Not because your portfolio is red, but because it's green and you think that means you're winning. Your app shows profits, your friends hype you up, maybe you even feel smarter than average. But behind the scenes, inflation, taxes, bad timing, and emotional decisions are quietly draining your future wealth. Hey guys, welcome back to Wealth Blueprint. If you're new here and you actually want to build real wealth instead of chasing hot stocks and dopamine hits, hit that subscribe button right now because on this channel we don't gamble, we build. Here's the uncomfortable truth. Most active retail investors in America underperform the market long term, not because they're stupid and not because the market is rigged, but because they confuse movement with progress. Buying and selling feels productive. It feels like control, but activity is not strategy. Every trade has a spread, market makers get paid, and if you're triggering short-term capital gains taxes, the IRS takes a bigger slice too. You feel like you're playing the game, but you might actually be the product. Imagine buying a stock at $50, watching it run to $65, feeling like a genius, then panic selling at $40 when fear hits. The real loss isn't just the $25. It's the compounding you killed, the confidence damage, and the hesitation next time opportunity shows up. In bull markets, almost everything goes up. So beginners start thinking they're skilled, but when cycles turn, that illusion disappears fast. By the time a stock is trending on TikTok or Reddit, smart money is usually already positioned and retail investors become exit liquidity. When everyone screams, "This can't go down," risk is highest. And when headlines predict doom, long-term investors quietly accumulate. The market transfers money from the impatient to the patient, but patience feels boring in a world addicted to hype. Comparison makes it worse because you see someone claiming they turned $10,000 into $80,000. Trading options, and suddenly your steady S&P 500 returns feel slow, so you take more risk without seeing their losses, stress, or taxes. Even if you're up 6% in a year, if inflation is 3 to 4% and you're paying higher short-term taxes, your real return might be tiny, which means your purchasing power barely moved. Owning 30 random stocks isn't diversification, and putting most of your net worth into one company isn't conviction, it's concentration risk. Risk tolerance sounds easy until your portfolio drops $15,000 in a month and you can't sleep. If you're investing money you might need in 6 months, that's not investing. That's gambling with your emergency fund. Many beginners don't lose because they picked terrible companies. They lose because they panic sell at the worst time and build reactions instead of systems. Real investors build systems with automatic 401k contributions, Roth IRA investing, low-cost index funds, clear asset allocation, and discipline. You don't need to double your money this year. You need to avoid blowing up. You don't need every trend, you need emotional control. Most wealth in America is built quietly through consistency, employer matches, tax efficiency, and decades of compounding. Before your next trade, ask yourself, is this research or FOMO? Is this aligned with my long-term plan, or am I reacting to noise? If you treat investing like entertainment, the market will charge you tuition. Sometimes hundreds, sometimes thousands, sometimes years of lost compounding. On Wealth Blueprint, we're not here to gamble. We're here to build slowly, strategically, and patiently, because real wealth isn't loud, it's consistent, and in the long run consistency beats hype every single time. I'll see you in the next one.